Welcome everybody on this bleak winter day. The weather's about as strange as the economy is, so I'm not sure which is more upsetting, but it's a beautiful day out today. I'm Dave Myers. I'm the director of the Berks Alliance. We want to welcome you to our program today, our community forum, which will be featuring us economic forecast by the Federal Reserve Bank. What we do is ask well, let me do this. I'm going to introduce John Weidenhammer, who is the chair of the Berks Alliance, and then I'll come back and cover the ground rules. John.
Okay, good morning, everybody. Soon to be afternoon. Dave, thanks so much for your efforts to put this session together. And I especially want to thank Rio Tasharo, who is going to be our presenter today from the Federal Reserve. But I also want to give a shout out to the Federal Reserve because they've been a great partner for the Berks Alliance in putting on a number of the presentations that we've done. And we've got a few deeper into the spring coming up that the Federal Reserve has been very helpful putting together for us. So just a reminder, everybody, if you could keep your audio on mute, that helps the audio quality for everybody. And as Dave said, keep your cameras on. Makes us feel like there's real people out there in the audience when we can see all of you. And hopefully everybody knows by now the Berks Alliance is a collaboration of anchor institutions in the Berks County community, and we're focused on community development and helping to improve the health, wealth, and education attainment of the citizens of Berks County, and that's really the foundation of our work. So Dave, I'll turn it back to you for a introduction for Rio.
Thank you, John. I'm going to cover the ground rules really quickly here. As John said, we want you to keep your cameras on, but mute your microphone. If you use the chat function at the bottom of the screen to submit your comments and questions, we will get to those when we get done with Rio's formal presentation. Any questions and comments that aren't addressed during this session,
she didn't message me.
I'm sorry. We will collect all the comments and questions, and any ones that don't get addressed during this presentation, we will send to Rio and he will get them back to us. As John mentioned, we record the program. We will send it to everybody who registered, so you can look at it again if you want. We also posted on the Berks Alliance website, and we posted on BCTV. So that's the general ground rules. We had hoped to have Julia Klein, who is a member of the board of directors for the Federal Reserve Bank of Philadelphia, to introduce Rio, but unfortunately Julia is tied up with some work-related activities. So I will go ahead and do Rio. Rio Tasharo is a senior outreach economist in the research department of the Federal Reserve Bank in Philadelphia. He's responsible for conducting research on current regional economic issues of the Federal Reserve's 3rd District, which includes Berks County, and informing external audiences on national and regional economic conditions, monetary policy, and the role of the Federal Reserve in the economy. Small task. Prior to joining the bank in June 2016, Rio was a business analyst at Bloomberg, where he was responsible for conducting research on issues related to equity data quality. He also has substantial teaching experience. He has taught ranging from high school AP economics to intermediate Japanese and intermediate Spanish at the college level. So quite a diverse background. He has a master's degree in economics from the University of Michigan in Ann Arbor and a bachelor's degree in economics from Kenyon College. So Rio, to you.
Good morning, everyone. Dave, thank you for that wonderful introduction. I'm going to go ahead and share my screen. All right, so hopefully everyone can see the screen okay and hear me okay. Again, thanks very much for having me here. It's a pleasure to be here. So again, my name is Rio. I work in the research department here at the Philly Fed. One of my tasks this morning is to give you some brief remarks about what I see in the economy. But another thing that's very important in terms of my job is to basically hear from you and collect data from you. So throughout the presentation, I'll be conducting a little polling exercise. So I'll explain what that is going to be in the next slide. But before I can do that, of course, I do have to preface my presentation with a standard FLET disclaimer that the views expressed today are my own. So, when I do this type of presentations in person, generally it's a little easier to be more interactive. Unfortunately, we can't do that in a virtual environment. So the next best thing is to, use technology to, collect your opinions. So if you don't mind, assuming that you're not watching this on your phones, taking out your phone, opening up any sort of browser, and then you can go to polev.com/Philadelphia, which stands for poleverywhere.com. /Philadelphia. Once you go there, you'll be prompted to, enter a name. I'm not interested in any individual responses. I'm interested in sort of a group response from this particular group. So feel free to either, enter your initials or, there is an option to skip that entirely. So you can do that. And then after that, hopefully you do that process, you get to the screen called waiting for presentation to begin, at which point you can just leave your phone close to you because once the questions come up on the screen, you'll be able to answer directly from the phone. So I've been using this for a while now, and it seems like this is a pretty good technology that works well with this type of presentation. So keep your phones close to you because I'll be asking you a few questions throughout, just so that we have this sort of more interactive portion for this program. Anyway, so with that out of the way, let me actually talk about, what I'm going to be talking about for the next 45 minutes or so. So I have roughly, divided this presentation into roughly 3 parts. So I'll be talking about, what has actually gone well in the past 6 months or so. And then in the next 10 minutes, I'll be talking about some of the challenges. And then last but not least, of course, the inflation has been one of the most discussed topics in macroeconomics today. So I'll be spending the last 15 minutes or so talking about what's going on with the inflation currently, as well as where I see inflation going in the next 6 months or so. Okay, so before I talk about any of the specific data, let me actually talk about sort of the overall economic performance for 2022, just so that we're on the same page about, just so that I can give you some context about where we have been for the past, let's say, 5-6 quarters or so. So the chart that I wanted to start us off with is the chart for gross domestic product, GDP growth by component. And as you can see, we now have, data for all 4 quarters of 2022. So we can actually, look at, where we have been in 2022 compared to 2021. So if you look at the overall growth for last year, 2022, undoubtedly, we have seen a fairly, I would say much more sluggish growth in 2022 compared to 2021. So as a matter of fact, in 2021, the annual growth rate was about 6%, 5.9% relative to 2020. And the annual growth rate for 2022 relative to 2021 was about 2.1%. So not too terrible, but obviously relative to what we experienced 2 years ago, that was very, very sluggish. So what happened? Well, one of the most important components of GDP, I would say the most important components of GDP is this blue part of this chart, which is personal consumption. So personal consumption accounts for about 70% of our GDP. So, logically, it makes sense that, if this most important component of GDP has been sluggish, well, the entire economy is going to be sluggish. And as you can see from this chart, consumption portion has been, fairly sluggish, to say the least, in basically all of 2022. I would say that another component that saw a weakening in 2022 was basically business investments, right? So this is, another component that's, I think, is very important, which includes things like, residential investments, which is, when people buy new homes, as well as non-residential investments, which is essentially, businesses making, investments in themselves. And you can see that, particularly in the middle 2 quarters of 2022, this data basically became negative, meaning that we actually saw a negative growth in this particular component. So combined this with the previous blue parts, the personal consumption parts, you can really see that in all of 2022, those are really the main drivers of why the 2022 growth overall has been fairly weak. So those of you who are wondering why, despite those 2 sort of weaker components of GDP, why did we have actually, positive growth in 2022? Well, it's because of the following sort of, I would say, unsustainable components of GDP that actually did well. So the first component of GDP that I think is not sustainable into the future is the growth in exports, as well as the deceleration in imports. So in both Q2 and Q3, particularly of 2022, as you can see from the brown part of this chart, we did see a huge acceleration in exports, which is an addition to our GDP. At the same time, particularly in Q3 of last year, we saw a deceleration in imports. And if you think back to Econ 101 days, you'll remember that import is actually a subtraction from our GDP. So essentially, the lower this yellow number is, the better for the economy. So this combined with the fact that we saw a unsustainable acceleration in exports meant that the net export numbers actually grew fairly quickly. So that's number one reason for why we had such a positive reading for overall GDP in Q3 and Q4. Another reason why we had a positive reading in GDP in Q3 and Q4 was the sort of increase in government spending, which is the last and the purple component from this chart. And you can see that, yes, Q3 and Q4, we did see government spending actually increase and grow fairly substantially. And this component is usually not sustainable. What happens usually is that they go up 1 or 2 quarters and then they go down again. So again, if you're wondering why the overall growth was actually not negative, despite the fact that the 2 most important factors of GDP were sluggish, was because of number one, exports and net exports were reporting good numbers, which I don't think is sustainable, as well as government spending actually went up quite substantially in Q3 and Q4. So really, those are the 2 reasons why we saw a surprisingly good number for Q3 and Q4. But I do think that the overall narrative here is that, when you look at both the consumption and when you look at what the businesses are doing across the country, the overall narrative here is that, we have seen a very slow growth in 2022. And I do think that in 2023, the similar sort of narrative and trend is going to apply, which is why I wanted to start with this chart, because what we saw in 2022, so far, we're seeing basically the same thing in 2023 as well. So now that I talked about the overall sort of narrative of where I think we're going in terms of economy, many of you might be wondering, so if we're starting to see a substantial slowdown in the economy, should we be worried about a possibility of recession? So let me actually walk you through that in the next slide. So when it comes to recession, it turns out that there are actually sort of very strict components that we can use to actually determine whether or not, in fact, we're in a recession or not. So these are the 6 most useful indicators to determine if we're in a recession or not. So just to give you some context, right, if you look at the 2 most recent recessions, so the first one in 07-09 financial crisis, indicated by the thicker blue shading, you can see that all 6 numbers actually went negative fairly quickly during those times. And so that's why we kind of knew that we were in recession back then. Same story applies to the most recent recession that we experienced due to COVID, which is the slightly thinner blue shading time zone. And you can see that, again, all 6 numbers actually went negative fairly quickly during those few quarters. So in that context, if you look at the current numbers, you can see that, yes, things are starting to slow down quite substantially, particularly relative to last year. But are these numbers so low that we should be concerned about a recession immediately? I do think that the answer is no, right? All of those numbers are still positive, meaning that things are still looking okay in terms of growth. Yes, I do think that the risk of recession in the next 6 months has actually gone up quite a bit. But if your question is, are we in a recession right now, or are we in an immediate sort of risk for recession? The numbers actually tell us that the answer is probably no. So now that I talked about the overall slowdown of the economy and potential probability for recession, the next 2 sections that I will be talking about is going to be, one, what has actually improved over the past 6 months, followed by what are some of the issues that we have in the economy today. So let me start with the good news. Before I talk to you about any of the data, let me actually poll you for the first time. So if you can grab your phones And if you go again back to pollf.com/Philadelphia, you'll be able to answer this question. So the question is, how do you feel about traveling by air? And the reason why I'm asking you is that when you look at different components of the economy, not everything is slowing down, obviously, right? Because there are some industries that has been performing remarkably well. So really, the point of this question is to show you that air travel has actually been one of the components where we are seeing a pretty actually substantial increase in activities, particularly since the last holiday season. So let me give you about 15 more seconds for people to answer this question. If you are joining us late, again, you can take your phone and answer this question by going to pollf.com/Philadelphia. So thank you for about 30 people who have already answered this question. It does look like basically majority of you have actually have been traveling by air. About 16% of you haven't been feeling comfortable. So let's actually show you basically what the sort of general public's sentiment is. So I took this data from a TSA website. So if you go to TSA website, they actually do give out this type of free data. So what this picture is showing is that the number of people who actually go through the security gates in each of the domestic airports in the United States, comparing it to 2019. So compared to pre-pandemic periods, what are we seeing in terms of air travel activities? And so what's interesting here is that so first of all, when you look at the data for the past, let's say 24 months to 12 months or so, things have actually been sluggish, even though we have seen a substantial improvement in this particular sector. What was interesting about this immediately past holiday season, so basically November, December, and maybe January of this past holiday season, was that people have actually really been traveling by air, and you can really see that from this chart that we have seen a consistently above 100% growth in terms of where we have been, meaning that it does look like even compared to pre-pandemic levels, people are feeling sort of more optimistic about traveling by air. This is one sort of very small examples of where I'm seeing basically improvement in activities. Now, of course, we can this is just one example, but we can expand the argument by talking about let's say restaurants, hotel reservation, etc. And all of those data are showing improvements and positive signs. So when I talk about slowdown in consumption and slowdown in economy, yes, the average number tells us that things are slowing down, but this data basically I just wanted to share this data with you to remind you that there are some aspects of the economy where that's not the case. Speaking of good news about the economy, one aspect of the economy that has been consistently performing well has been the labor market. So this map shows basically the current level of the labor market relative to February of 2020. So February of 2020, if you remember, was the pre-COVID peak in terms of job numbers. So what we want to know is relative to the pre-pandemic levels, where are we in terms of the number of jobs? So obviously there is some regional variation, yes, but I do think that overall, we are looking at fairly positive numbers. Things are actually consistently positive in terms of job growth. We are in the letter U, Reading MSA, which is just a fancy way of saying Berks County. So Berks County, it seems like it is a little slower in terms of overall recovery. It's looking about 96 to 97% of the 2020 levels. But nonetheless, if you look at the timeline of recovery, we do see very positive sign. Berks County and even of course the neighboring areas are seeing some consistent numbers. I would say that for Berks County in particular, one of the issues for slower growth may not be about the demand. It may also be about supply of workers. So I'll talk about that in a minute. But because Berks County relies so much on things like healthcare, providing sector, and we know that that sector has been consistently being challenged by, let's say, a shortage of nurses and doctors. And so, that might be, that might be one of the issues for Berks County. So I'll talk about some of that in a minute, but for now, it does seem like overall, the trend in terms of, job recovery, almost everywhere in the state, we're seeing, very positive trend. And that's logic is really similar for unemployment rate, right? So unemployment rate essentially is the rate of people who are, looking for jobs and who do not have jobs. And you can see that at all levels. You can see that, these numbers are essentially either at or even below pre-pandemic levels for Berks County in particular at 4% unemployment rate. You can see that that is actually lower than what we saw pre-pandemic. So you can see that, in terms of both the local, state, and also the national level unemployment rate has been, fairly low, which again is a very good news. Another good news that's stemming out of the labor market is the slow but sure recovery in terms of labor force participation rate. Now, if you look at the bottom line in this chart, which is the total labor force participation rate, that is not showing a consistent growth. And one of the reasons, or I would say one of the biggest reasons for that is that people actually retired en masse during COVID. So unfortunately, that black line at the bottom, I don't think is going to come back anytime soon. But the good news here is that if you look at the top line in orange, this is the labor force participation rate for prime age workers. So those who are between ages 25 and 54. That number has actually shown a remarkable, improvement over the past couple of months or so, meaning that for whatever reason, yes, people actually went out of labor force in the first couple of months of COVID, but that number has actually improved substantially over the past couple of quarters or so. So when we think about, what's improving in the labor force, perspective, we're seeing, some encouraging signs that people coming back from the sidelines to take jobs, as you can see from the increased labor force participation rate for the past couple of months or so. All right, so now that I talked about some of the improvements, let's actually, go ahead and talk about some of the challenges. Now, for that, I do have some data, but before that, I actually do want to hear from you about what you are seeing in terms of challenges. So here's the second question for the group. Which is in the current quarter, which of the following factors acted as the top constraint either on your business or your client's business operations? So again, let me give you about 30 more seconds for people to chime in terms of where their sort of the top concerns are, right? So again, if you own a business, great, you can talk about your own business, but if you deal with your clients primarily, you can think about your typical clients experience as well. So far we have about 25 respondents and we have about 20 more seconds, but it looks like labor supply has been basically the top concern for this particular group. Financial capital, and it looks like 10% of you said other factors. So maybe during the question and answer session, I'm actually curious to hear from those who said other factors, what those factors are. Again, thank you for answering this question. So let me actually show you what the sort of larger group thinks, and it actually looks fairly similar. So for those of you who don't know what we do, in a research department, one of the, I would say, main things that we do is that we actually produce a lot of surveys and put that out there for public consumption. So every quarter, we ask our business contacts about basically the question that you just answered. What is the top constraint on your business in the past quarter? And as you can see, regardless of what sector you might represent, we have seen a fairly consistent theme across the business context that we have last quarter, which is, labor supply has been, the number one and the most frequent cited constraint by our business context these days. And then this was actually a little surprising, and this may actually have applied a little bit less for this group, but supply chain has been a pretty big issue. So what I would like to do is talk about, a few sort of data sets that I have that would show that labor supply and supply chain issues are indeed, some of the largest roadblocks or constraints for businesses, not just for the area, but for across the businesses across the country. So the first thing I want to talk about is labor supply. And so for labor supply, I'm going to show you some data, but I also want to actually hear from you about, specifically about, your labor supply and what you are experiencing for your business or maybe for your typical clients' businesses. So the next question for polling is about that. So what I want to know is, over the last 6 months or so, how has your firm's headcount changed? Have you had to, lay off people? Are you still looking for people with some success, without some success? Let me actually give you about 30 more seconds for people to again chime in. So, the question before, I want to ask you about, a typical problem, and of course, 60% of you said that you've been having issues with labor supply problem. I want to actually, see what is the the exact problems that you've been having. So far, it looks like more than half of you said that you've been maintaining the headcount. About a third of you said that you are trying to increase headcount, but less than you had anticipated or would have liked. And then 10% of you said that reduced headcounts by not attempting to replace workers who have left their firms. Again, thank you very much. So it does look like whatever people in this virtual room has been feeling or has been experiencing is actually fairly it's been a fairly sort of widespread experience by many of the business owners across the country, right? So in terms of where we are in terms of labor supply, we can really see from the data that labor supply has been fairly limited and labor demand still has been very high. So in terms of labor demand, if you look at the blue line for this chart, you can see that we still have about 11 million job openings total across the nation, which is a little bit lower than what we saw in the summer. Yes, but if you look at the historical data, this is absolutely still at a very high level. So if you're one of those firms who said that you've been having issues with hiring people or replacing people, it seems like this is a very typical experience for many American firm owners. Another thing, if you look at the yellow line towards the bottom, this is the quits rate. So basically, this is the number of people who voluntarily quit their jobs to presumably to take on another job. And you can see that that number has been consistently above 4 million people for at least the past 24 months or so. So you can really see that both the labor supply is very short, because either you are competing for the same type of workers with many other firms, and again, labor demand has been very, very, very high for quite some time, as indicated by the blue line at the top. Moving on to supply chain issues. So supply chain issues has been, very, I should say, a little confusing for me. And maybe perhaps if you are one of those people who answered, you're having issues with supply chain in the previous survey question, you can perhaps share your opinions with it. But it looks like when I look at the overall global supply pressures index, things start looking much better than it was 2 years ago. So the clearly it looks like the worst is over. So the high of this of the series is December 2021. So relative to that level, yes, supply chain pressures index seem to be fairly low, but perhaps relative to the historical level, we're seeing still some high levels. So the current reading of about 0.9 is still, much higher than the historical average of about basically 0. So for those of you who said that you've been having issues with supply chain issues, I'll be curious to see what type of specific issues you're having. But overall, it seems like things are looking better. Relative to what we saw in 2021, but perhaps we're still seeing some hangover impacts from what we saw from 2 years ago. So obviously, if you're a firm owner or if you run any business, you have a lot of things to think about, including things like supply chain issues, as well as labor supply issues. So as a result, when we ask them about their opinions in terms of the future outlook, I'm not gonna lie, things look a little bit less optimistic, right? So you can see that again, regardless of what sector people represent, the numbers that we're seeing here are fairly pessimistic. You can see that those numbers actually went down fairly quickly over the past 24 months or so. We have seen some, I should say, very little increase in these numbers in the last 2 readings. But overall, in terms of the sort of the average sentiment that we have been seeing, it looks like business, partners around our district are feeling, very pessimistic about the next 6 months or so, because of some of the issues that we've been discussing for the past 5 minutes or so. All right, so now that I talked about some of the issues except for inflation, let me talk about and address the the pink elephant in the room, which is what's happening with inflation, and what is happening with inflation right now, and what is my outlook for inflation into the future. First of all, when you look at the data, it's of course no secret that things have become more expensive. I don't have to tell you that. I think a lot of people have experienced that, and that is regardless of what specific measurements that you're looking at, right? So if you look at the headline number in orange, of course, you're seeing above 6%. Same thing with core numbers. Another thing that's I guess popular, another measurement that's became popular since the last FOMC meeting is the CPI core services less housing. So this is what Chair Powell was talking about when he talked about the super core CPI inflation. But really, regardless of what specific measurement that you're looking at, if you compare the current level of inflation to the historical level, it's no secret that it's being much too high. So in terms of monetary policy, it is the #1 sort of top priority to make sure that these numbers go down as low as possible, so that we can go back to the normal 2% level. Now, when you think about inflation, of course, it's important to think about the overall, I would say, shape of this chart, the overall trend in terms of the inflation, but I think it's also important to think about what is the underlying driver, or what are the underlying drivers of these price changes, right? So for that, let me take the orange line and then sort of divide this by different components that make up the calculation for CPI, which comes out to be like this. I would say that there are two observations here. One, if you look at what is actually driving inflation, or what has been driving inflation for the first half of this current episode of inflation, so basically up until, let's say, mid-2022, it has been driven largely by goods, right? So the goods are the orange, food, which is red, and then energy, which is green. And you can see that those components have been largely the main drivers of CPI inflation up until first half of 2022. What's interesting here is that ever since the summer of 2022, that relationship has actually reversed, right? So if you look at what's actually driving inflation right now, it's basically mainly services. So those are the different shades of purple. So shelter is the largest component in the darkest shade, and then you can see that the other shades of purple represent other categories of services. So as we are, as an economy has been stepping out of the pandemic, of course, during the pandemic when we couldn't, get these, services, even if we wanted to, of course, we were spending a lot more money on goods. So that made sense that the goods, prices were the main drivers of CPI inflation. But now that we are, out of the pandemic, and many of us are doing the activities that we weren't doing for the past 2 years, like air travel, like going to restaurants. You can really see that price changes are being driven by different categories of services, mainly shelter, but also we are seeing some increases in services of core services. So that's the what we're seeing in terms of inflation, inflation today compared to 12 months ago, right? So one of the criticism that I've heard oftentimes is why are we comparing the price levels today to 12 months ago? Because if things are changing so rapidly, perhaps we might be missing some of the more recent changes in prices. So for that, let me actually show you the next slide that basically talks about the more recent changes in prices. So I know there's a lot going on this chart, so I'm going to actually walk you through what's going on in this chart. So the movement left and right, the horizontal axis or the x-axis is basically what you saw in the previous slide. So 12-month year-over-year growth rate of prices. So what's happened today versus where it was 12 months ago. The important thing for this chart is movement up and down. So movement up and down is what's called the 3-month annualized growth rate. So basically we take the price changes for the last 3 months and apply that to the next 12 months. And so basically we assume that the price changes that we're seeing in the past 3 months will continue on for the next 12 months. And so, this movement up and down is going to tell us that if we assume the most recent changes in prices will continue into the future, what is inflation going to look like in the next 12 months or so? So, and then you can see that, this chart is divided into 4 quadrants. And so essentially where we want to be is the south half of this chart, right? Of course, we want to be, where, many of these, expenditure items are in the disinflation category, where we're seeing, of course, some inflation, but not as high as we're seeing right now. So in that context, the bad news here is that many of the categories that we're seeing here is still in the south, still in the northeast quadrant of this chart. So we're seeing that some of these items not only are experiencing high inflation year over year, but we're also seeing high inflation in the last 3 months or so. So really the point of this chart is to show you that, until some of these bubbles actually go down to the south half of this chart, unfortunately, inflation might be still stickier than we had initially thought. So, of course, in theory, if we do want to see, overall inflation go down, we do actually need to see some of these charts go down to the southern half of this chart first, right, before we start seeing the movements from right to left. So again, not to discourage anyone, but it does seem like inflation has been rather sticky. So if I have to guess, inflation has been sticky so far, and going forward until we start seeing some of these items go down to more of a more reasonable levels. I do think that the overall inflation may stay at high levels for quite some time. So in the next couple of slides, let me actually talk about some of the impacts that we've seen because of the high inflation. So the first thing I will talk about is the increase in wages, right? Or I should say increase in nominal wages. So this is where both the labor market data and as well as the price data are sort of coming together, right? So it's not like the firms across the United States have been sort of sitting back and waiting for applicants to come and apply for their jobs. It does seem like for the past I would say 24 months or so, firms across the country have been actually offering on average higher wages for their basically existing staff as well as new staff. The problem though is that of course is inflation, right? So whatever people have been receiving in terms of raises on average seem to be not enough to basically catch up with the cost of living. Right, so if we actually divide this picture by, adjust this by basically inflation, all of a sudden the picture looks like this, where most of these sectors are reporting negative year over year real growth, meaning that when you think about inflation adjusted growth in terms of wages, we are seeing fairly weak growth, meaning that despite the fact that yes, maybe an average person's paycheck face value may have gone up year over year, unfortunately that may have not been enough to catch up with the increase in cost of living. So of course, given this background of increased cost of living and higher nominal wages, but of course not enough to catch up with the higher cost of living, the way people have been viewing the economy has been fairly pessimistic, and this actually is kind of related to what we saw in terms of the business owners sentiments. But you can see that overall we're seeing very low sentiment from the consumer. We have seen some encouraging numbers for the past couple of months in terms of the numbers going up, but again, even the current levels are showing much lower levels than historical, right? So the historical levels are the dashed lines, and you can see that particularly the University of Michigan index is showing very pessimistic realistic numbers compared to the historical average, meaning that yes, consumers are being very sensitive to increase in prices and perhaps lack of lack of real wage growth for the past couple of years or so. So to combat inflation, obviously the Federal Reserve has been busy, aggressively increasing wage rates. So not wage rates, interest rates. So if you think about where we are in terms of interest rate environment today relative to exactly a year ago, it's actually interesting to think about. We live in a very different interest rate environment than we did 12 months ago, right? So essentially, we went from zero 12 months ago to almost 5% today, and you can really see that from this dot chart. Perhaps the policymakers are not done with increasing interest rates. So as of the December Federal Reserve's Open Market Committee, when they're asked about the appropriate paths for monetary policy, almost actually all of them said that the current level of interest rates is probably not enough to sustain or to combat the inflation rate. So it does look like by the end of 2023, we should be expecting a few more rate hikes, so that it does look like the median policymaker thought that we should be above 5% at least for 2023 before going down in 2024 and 2025. And this is a view from the policymaker's perspective, but if you ask the same question to market participants, it does seem like they're largely in agreement. So essentially, this is basically the market participants making a bet in terms of when the next rate hike is going to be. So it does look like the market has priced in another 25 basis point increase for the next upcoming March meeting, followed by another 25 basis point hike in the May meeting. And then June meeting, it looks like the market participants are split between hold at 5 to 5.25 percentage points range, or another 20 further increase in terms of Fed funds rate for further 25 basis point increase. So that part is not sure, but what is fairly certain in terms of the market participants' confidence is that the next two meetings may result in again 25 basis point hikes each. And then the last couple of slides that I have for you this morning, talks about what are some of the initial impacts from basically this, right, from going to 0 to almost 5% in about 12 months. What we saw immediately was response from more interest rate sensitive sectors like housing. So the green line is the Fed funds target rate, which is essentially what you saw in the previous slide. And you can see that as soon as the green line started going up, the red line, which is the 30-year fixed average mortgage rate, actually started tuning up as well. So you can really see that despite the fact that many of the average American may not be feeling the immediate impact from these rate hikes, that's actually not true for those who are in the housing sector, right? So obviously we're seeing some immediate impact from sectors like housing. And as a matter of fact, if you look at home price growth, for example, we're seeing some immediate slowdown in terms of home price growth. This is not to say that the home housing market has been. I don't think there's a concern for crash or anything like that. I think we're still seeing fairly high home price growth. But the home price growth is lower than what we've been used to, right? So we've been so used to seeing double-digit growth. So anything below that may seem like a less impressive number, but we're still seeing around 8 to 10% growth everywhere across the country. So that's something to keep in mind. Another area in which we saw an immediate impact in terms of the impact from the higher interest rate is consumer loans or loans in general. So when we ask about what's going on with the demand for loans, you can see that a typical lender actually saw a significant reduction in terms of consumer loans. As you can see, particularly for auto loans, for example, we're seeing some substantial decrease in terms of demand. Same thing can be said for commercial loans, right? So when we ask our banking contacts about what's going on with industrial/commercial loans, they're also consensus seems to be that they're seeing significantly lower demand from those loans as well. I do have one more last chart that talks about inflation expectation, but before I show you data, I do want to actually ask you what your opinion is. So the last question, and there's really no right or wrong answer because this is just your opinion, but tell me what you think about how should we be thinking about expectation for inflation? Do you think that inflation will return to 2% target level by the end of this year, by 2 years from now, 5 years from now, or do you think it will take much longer than that? So let me give you a few more seconds for people to chime in. Looks like there are some of you who are extremely optimistic. I like that. 11% of you said that by the end of this year, we're going to be seeing returning to long run 2% target level. But many of you think that we're going to be in this high inflation rate environment for the next 2 to 5 years. All right. Well, thanks again for participating in these survey questions. I really like having this audience interaction. So this is the data for now. This is the inflation expectations yield curve based on basically bond trading. And so I think so here's the good news, right? The good news here is that as if you look at the blue number, which is the most recent number relative to what we saw back in the previous month, which is December, we are starting to see some improvement in terms of inflation expectations. So people are starting to see have a little bit more confidence in terms of where we can be in terms of inflation. The bad news here is that we're still way above where we want to be. So really the benchmark here is the red line, which is a year ago. So a year ago, people's expectation about inflation in January of 2022 was the red line, and you can see that the current line in blue is still about 0.5 percentage point above that line. So we still do have some work to do in terms of keeping people's expectation about inflation more reasonable. But I'm happy to say that this line has actually gone down fairly substantially across I would say across the summer, and then obviously for January 2023 we're seeing that these numbers are basically within a percentage point for where we want to be. So before I take questions, I just wanted to give you a little bit of a summary of what I talked about. So one, I think the key takeaway from this presentation is that, yes, we are seeing substantial slowdown. It's no secret that overall economic growth has been slowing down, but let's not forget that there are some sectors in the economy where we're seeing some significant improvement, like air travel. I would say the labor market has been remarkably strong point of the economy, where we saw continuous strong performance. So that's fairly good news. In terms of challenges, of course, because of the labor market's performance, the flip side is that firms, if you are a type of firm who's trying to hire, that might be fairly challenging. And then supply chain issues, have been still a challenge for some of the business contexts that we talk to. And then in terms of inflation, yes, people have been receiving on average higher nominal raises than other years, but it does seem like it's been difficult to keep up with the increases in cost of living. As a result, consumer confidence has been on the low side. So we'll see what happens with the inflation data. I do think that the worst in terms of inflation is behind us. But really, the key question here is that those if you remember that bubble chart that I showed you, some of the key components of inflation is still fairly sticky in terms of prices. So going forward, the prices of some of those bigger bubble expenditure categories is going to be the key in determining when inflation is going to be going back to a more reasonable level. I know it's time for questions, but I just have one more question for my senior management here. So this is not going to be shared with this group, but if you can actually before we answer questions, if you can sort of submit what you thought about this presentation overall, and if you have any comments and suggestions about how to improve this type of presentation, please let me know. And then the last slide, after I give you about 15 more seconds for people to chime in, I'll give you my contact information so that if people have any questions beyond this morning or afternoon, I'll be happy to answer any additional questions that you may have. Again, it's been a pleasure. Thank you very much for participating in the survey. Hopefully, you had some fun interacting with the speaker today. Here's my contact information. I did share this slide back with Dave, so he can share the slide deck with you after the event. But for now, I'm going to be quiet and see if people have any questions. Thanks again.
We're not going to let you be quiet. Thank you. There's a lot to absorb here, a lot to absorb. Couple questions that I have, and I'm going to ask people, if you have a question, please do it through the chat function or let me know you want to ask your question personally. I'm going to call on some people, I think, as we go along here. But Rio, are you suggesting that we're going to see 2 or 3 more interest rate increases in the next couple of years?
So I would say next couple of meetings, right? So the market consensus, they put 90% probability of another 25 basis point hike in the March meeting, followed by another 25 basis point hike in the May meeting. So it seems like the strategy here is to go a little bit slowly, so increase, get to above 5% in the first half of this year, and then see how the market reacts afterwards.
Okay. I do want to emphasize that, as you said at the very, very beginning of this, what you're expressing are your opinions about some things,
That's
not
right.
necessarily
I
the
should
Federal
double
Reserve.
down on my disclaimer that these are my opinions, and don't go tweeting saying that the Fed Chair Powell thinks this way or that way. So these are my opinions and my interpretation of the data that I see.
Yeah, Rio, could you pull down the slide so we can see everybody in the audience, so I can start to see hands and faces? So this is your personal opinion that I'm going to be asking here. What do you think the likelihood is of a recession based on what you've been watching in the next year, 2 years, 3 years?
That is a very, very good question. So if you had asked me this question before the beginning of this month, when we had the January job report, I would have said fairly high, around let's say late summer, fall. But we know that the January job report came, and that surprised us all, where we saw basically more than 500,000 jobs added on net. So I do think that probability actually went down quite substantially. So this could mean that I don't know if we can avoid recession altogether. If we do have a recession at some point this year, it does seem like things can get milder. It does feel like the potential recession, judging from the data that we have, can be mild and short. But certainly I think the January job report that came out in the beginning of this month actually changed the narrative actually quite a bit in terms of what's to expect. And I do think that the probability of a hard and depressing recession has actually gone down fairly substantially.
One of the things I thought was interesting is that you talked about over time mortgage rates are probably going to be going up, and the cost of housing is increasing fairly significantly. We're facing, people say, a housing crisis here in Berks County. What impact do you see that having going forward?
Yeah, so 2 things, right? One is still a supply issue, right? So and this is nothing new. We've been dealing with low supply of inventory, not just in the region, but all across the country for quite some time. When you look at some of the data for housing starts and housing permits, things are not looking great. So, these are very well documented numbers that are rarely revised. So we know what's going to happen in the next couple of years or so, and these numbers are fairly low, meaning that we shouldn't expect the inventory issues to basically resolve anytime soon. So that's the supply part, and then in terms of demand part, we're still seeing high demand. I think the issue here is that a lot of the potential homeowners, particularly the first-time home buyers, may not be able to afford in the current environment because one, prices are still high, and then two, the rates are very high. In theory, when we see higher rates, we should be seeing prices go down. I think in this environment, we're not seeing that. We're seeing still higher prices as well as the higher rates. So affordability has actually gone down quite a bit. So I think in terms of both the demand and the supply issue, unfortunately, the housing, I would say from the affordability perspective, I think housing is going to be, I would say, continue to be an issue.
Okay. Going back to your very first group of slides, you talked about the significant increase in exports and the impact that was having. What is driving that? What are you seeing? How's that affecting the economy?
Yeah, so for the middle two parts of the last year, what we saw was that, so one, this is when China still had the zero COVID policy, so we couldn't get anything from China. So a lot of the producers in the country actually switched to domestic producers. So instead of importing stuff from abroad, particularly China, we actually did a lot of the businesses around the country actually switched to domestic producers, and they actually ended up exporting many of their products to overseas. So that's what we saw. Now that China is completely open again, this is why I'm saying that I don't think this is a sustainable way to grow, just because it looks like China is back to business again. So that part is going to go.
You see that having an impact on manufacturing, which is a core part of the economy here in Berks County.
So in terms of impact, I would say that the anomaly was the middle two part of last year, right? So before that, we've been seeing essentially, on trend growth in terms of manufacturing. I think the China issue will probably just bring us back to where we were. What the slowdown that we're seeing now is, I would say not exactly related to what we saw in terms of China, but it's really the general slowdown in the economy is what's driving the general slowdown of the manufacturing sector.
Okay. You talked about wage increases, and there's been a lot of conversation about employers increasing wages as a way of trying to attract employees. But it looked like from the one slide that the only sector where that was really having a consequence was the travel and leisure section. Is that right?
Let me check. Yes, it looks like leisure and hospitality is so far the only sector that has positive real increase.
Okay, and even there, we can call on people here involved in that industry, but I think they're saying they're having trouble finding employees and retaining employees as well.
Exactly.
John, I'm gonna let you ask some questions. Why don't you unmute and ask the last two questions you submitted here?
Okay. So Rio, thanks again for a great presentation. I really appreciate it. Does the Fed have a position relative to advocating for the reshoring of manufacturing of some of the key things that we consume in our economy, like pharmaceuticals and semiconductors and so forth?
The short answer to your question is no. We don't. That's not in our toolkit. But what we do is, we analyze. Obviously, what are some of the strengths of the region? Where are we seeing some strength? Where are we seeing growth? Where we're not seeing growth? And manufacturing may be a part of that conversation.
Okay, thank you. The other question I had was, what do you see happening to energy prices? I realize that that's a complicated global phenomenon, and the war in Ukraine and other factors really play into that. But as you look out over the next, 24 months, what do you think is going to happen to energy?
Yeah, complicated question. in terms of the impact from, Russia, Ukraine, of course, the longer this drags on, the likelihood of, us getting impacted in the local area is going to be higher. We haven't seen the impact of that just yet. And that could be just a function of us, so far having had, a relatively mild winter. So perhaps the demand for energy hasn't been where it has been, pre-pandemic. But I do think that, the longer this drags on, the higher the probability of us being impacted is. I think so far, when I talk to our business contacts, it seems like, the impact is still fairly limited, at least not not to a point that where it would be the main point of discussion when I talk to these business contacts. But yes, I think a lot of these people have this in the back of their minds, and they think really the consensus here is that the longer this drags on, I think the higher the probability is for us to be impacted in a more significant manner.
So one more, if I could, Dave. So
Sure, John.
So the Fed has announced that it's going to begin to unwind the balance sheet. Do you see any kind of unintended consequences from that action that would either cause the Fed to reverse direction or stop or slow down unwinding the balance sheet? But maybe you could just talk about potential unintended consequences from, really sort of contracting the money supply as the Fed seeks to unwind the balance sheet.
Yeah, this is a very important and good question. So let me actually take a step back and talk about what has been the sort of the policies, right? So in terms of tighter monetary policy, we are using two main tools, right? One is obviously Fed funds rate. We've been increasing that, and the other one is unwinding the balance sheet. So the lower the balance sheet is, or I should say, smaller the balance sheet is, that should give upward pressure in terms of real rates. What we want to focus on, or at least that's my interpretation of the statements that I've been reading, is that we really want to use the Fed funds rate as the main tool to influence the economy, right? And we want to make sure that we are unwinding the balance sheet, but this actually goes in the background. So for in that context, what they've been doing is that they've been trying to be very clear about what they intend to do. I think statements are fairly clear in terms of the scope and the speed at which this balance sheet balance has been is going to be decreased. So I think one important thing here is that we want to make sure that people don't really have to worry about the unwinding of the balance sheet part of the economy. I think as long as we make it clear and we're transparent about how and when and how quickly we're going to do it, we can actually use the Fed funds rate as a main tool to influence interest rate. So in terms of consequences that we haven't been thinking about, I think this is exactly why we want to make sure that we're clear about how we're clear about what we're doing, right? So that there's no confusion about what's going to happen.
Okay, and I appreciate your hesitancy at talking about unintended consequences, but we're kind of in territory that we've never been in before. So it may be that things happen that we really don't expect. So
yeah.
I guess we can leave it there.
I mean, the unintended consequence obviously is that when we if we let's say unwind the balance sheet too quickly, that's going to have the unintended consequence of having basically stronger upward pressure in terms of interest rate, and we may actually not want that, right? So if we actually if the interest rate environment goes up too quickly, then that is going to potentially trigger a recession. So we don't want to do that. So I think slow and steady, and I should add boring, is probably the way to go in terms of balance sheet unwinding. I think I do think that when as far as I can see from the various statements from the balance sheet unwinding, it does seem like slow and steady, and again boring is something that they've been trying to do, so that we don't change the real interest rate so quickly.
I'm going to ask a question. I'm going to call on a couple people in the audience. You mentioned early on about the role that government spending had in terms of trying to ease the pressure. Can you talk a little bit more about that, what that means?
Yeah, I think the context that I was talking about was the increase in GDP for Q3 and Q4 of 2022, right? So so if you look at the data, both of those are increase in defense spending. I don't think it was, I think it was just a scheduled spending that just happened to be added to the GDP number. I don't think it was directly trying to impact, the economy or directly trying to impact consumer behavior or anything like that. I think, every so often, the federal government does, does have a few quarters where they have a big chunk of spending in defense, and Q3 and Q4 of 2022 happen to be those quarters.
We had a question from Chris Need, so I'm going to let him ask his question or questions. There are two actually. Chris?
Hi, Rio. Just a quick question. Wanted to ask what the level of stress of having rates at this level does to the debt, and then a second part, if you could just explain and shed more light on the reverse repo program, sort of how it works and the effects of it.
Yeah, so let me answer the second part of the question first. I'm going to be honest with you, I don't know. I'm not in the regulatory side, so I can ask around my colleagues, but that's something that I don't deal with. The first part of the question, I think it's interesting. I think the whole point of increasing the interest rate is to discourage borrowing and spending, right? So in that context, I guess you framed this as stress, but really the whole point of slowing down, the whole point of increasing the interest rate is to slow down the economy. So if it's as a consequence, if it's results in slower spending and slower borrowing from the government side as well, that's working as intended.
Thank you.
Yep.
I'm going to call on a couple of people who are maybe anticipating being asked questions. Dan Fogarty, you're clearly involved in workforce and the workforce issues. What are you seeing, and how does this relate to what you're seeing? Dan's in charge of workforce development for Berks County.
Yeah, I think Rio nailed it early on. We don't have a demand problem, we have a supply problem. And a lot of that is demographics, which are pretty stunning in terms of the aging of our population. Looks like about 2 years ago, we peaked at the number of 25 to 29-year-olds that we're going to be seeing in the next 10 years. And so that's bad news for employers and industries that are trying to bring people in and train them and upskill them, because on the other end of the spectrum, there's no end in sight in the increase of 65 and older population in Berks County. So that's a big driver of the supply problem. On the good news side, like you said, that 4.0%, that's the lowest we've been since Y2K. June 2000, I think Bill Clinton was still president, was the last time we saw the rate at 4.0%. But we still have about, I like the chart where Rio showed the recovery of the job market, where we're lagging a bit here in Southeast PA. We're still missing about 7,000 workers, Dave, that we had 3 years ago when this thing hit us. So yeah, it's a supply, and across the board, even manufacturing, things are slowing down a little bit, but they're still trying to hire a little bit better traction. But the reality is that there's just not enough workers to fill the jobs that are open.
And how's that affecting wages, Dan?
So wages are going up, right? And you mentioned the one thing, and real wages aren't, so that's a problem, but nominal wages definitely are. Even you mentioned leisure and hospitality, so relative, they did pretty good, but you're still probably earning $22,000 a year if you're working in that sector, at least on the books. That's a little bit, that's a sector where there's a lot of unreported earnings. But even those unreported earnings fluctuate. So we're seeing wages. Just we're talking to some manufacturers. They think they're getting a little bit more leverage with their workforce. But some of you may have seen the manufacturing to go unnamed running billboards for industrial maintenance technicians starting at $38 an hour, on every major highway coming into Berks County. So for skilled jobs, that pressure is going to continue.
And I'll come to somebody in the leisure, travel and leisure section in a second, but I want to call on Ted Fries to talk. Ted is involved with Enersys, which is both a major manufacturer, but also involved in the energy industry. So Ted, your feelings about this?
Yeah, well, first I would just say thank you, Rio. I thought it very informative, and again, I thought the numbers were spot on. We are a global business, so it's not just Berks County for us, but I think labor has been a very significant issue. We've largely overcome that for the moment, but it hasn't been inexpensive. It's been a very costly item to overcome. And I would say the other area that's still an issue, but not nearly as severe as it was at the height of the pandemic, is the supply chain. There's still significant supply chain issues that can occur, and we certainly have done our fair share of reshoring or going to different shores, but also raising our inventories quite a bit in certain key components, just try to meet the demand. I will say for us, and we may be a little unique in the markets we serve, but the demand side for us continues to be extremely high. So we are for the most part in a situation where if we can produce it, we can sell it.
Great. Crystal, I'm going to call on you because you know the travel and leisure industry.
Okay. Anything specific there, Dave?
Just your reaction to what Rio, or do you have any questions for him?
I don't, I agree with Dan. Dan and I have had a lot of conversations about the leisure and hospitality industry. We've had focus groups with those in that entire industry and understand where they're at. One question I did have, Raya, was when in the chart that showed the wages popping for leisure and hospitality and then dropping, was that cumulative, that drop? Was that drop from the high point down, or was that?
It's year over year.
Year over year, okay.
Yeah, so I think when it went up, I think it was a base effect. So it went from fairly low, let's say $9 an hour to whatever. So you saw a big jump, and then after that, maybe the jump wasn't as much because it was already high.
Right, and so everybody on the call knows. I think when we're talking leisure and hospitality and the big jump, as Dan was referring to, I think we're talking more the staffing levels, like your lower level staffing levels, not your accountants and your lawyers and those type of people that work in that industry as well. I do know that we're seeing in our hotel occupancy here locally in Berks, we've held really strong. We actually did better than the national average over the past 3 years. A little higher percentage wise, and we've actually increased the percentage of occupancy we had over 19. Our average daily rate has increased significantly by probably $20 a night per room here, which is pretty substantial. I know, we're happy with that. Now, how long we can hold it based on what you're telling us on transportation.
Crystal, you got muted.
I don't know how I got muted. Sorry, I didn't touch anything because I talk with my hands. So as you all know, I don't know where I left off, but what I was saying was, we saw an increase in our average daily rate, which is good by about $20, and in most cases, and but overall, I think that's great. I just don't know where what you've been sharing with us is going to take us for the next year or two, because if the consumer inflation is increasing and people are afraid, will they travel? We're fortunate right now because we are a road trip location. And if gasoline prices go down, it may help us draw more people into the area for a 2-hour trip rather than getting on a plane. So there's some things to consider there. And in food inflation, of course. I'm concerned for our restaurants because I know people, right now, there's not been much of a decline, but I think as we go forward, if how long inflation continues, that's going to hurt.
Thank you. I'm going to welcome Julia Klein to the conversation. Julia is director for the Federal Reserve Bank in Philadelphia on their board. And Julia, what's your perspective on what the Fed can and can't do? How, from your inside perspective about this, what should we think? What should we be feeling here? Optimistic, pessimistic?
Well,
I know you're not
thank
happy
you. And,
right now.
and I apologize for being late. We actually had a Federal Reserve Bank board meeting all morning. Rio, thank you very much for your presentation. You know, we're so fortunate to have just really brilliant economists like Rio on staff doing research and whose job it is to translate and share the information that we have. You know, I think I would comment that the Fed's mandate and toolbox is really very limited. We only have a couple jobs. It's to supervise the bank, the banks, kind of all the banks from the biggest investment banks all the way to local community banks. And it's to provide research that informs policy and helps policymakers. And then to use the only two tools in the toolbox, the Fed funds rate and the balance sheet, to hit inflation and employment targets. That's it. So everything else that we're all talking about, everything around regulation, manufacturing, labor force, immigration, all of that is policy that is the work of Congress. And the Fed's role is to provide the data and the research so that policymakers are making good decisions based on real data. But that's it. So the Fed doesn't have policy on anything other than the banks and using the tools at our disposal. I'd also note that and again, so I'm speaking just for myself here. The pandemic problems that have caused inflation have all been supply problems, as Ted mentioned. You know, we still have significant labor problems. There's still, although the supply chain issues are much improved, there are still a lot of knots depending on your niche. And the Federal Reserve tools really can't do much, if anything, about supply. The bank's tools, the system's tools affect demand in heating up or cooling off demand. We can't do very much about supply. So there's an interesting disconnect in where policy gets set and how quickly the tools in the toolbox are really able to change the trajectory. Now, you can see as, you know, there's a lot of liquidity in the market. So you've seen what's happened with inflation, and the tools to cool that demand are in place, and you're seeing some cooling. I can't speak to what that trajectory is or what the time frame is, but I think it's important to have a really full understanding of what's really available. In terms of the Philadelphia Federal Reserve Bank, we have a real specialization in consumer finance. We have a consumer finance institute that has all kinds of data on how people spend money on debt, housing, student loans, all of that kind of thing. And it's really the best in the country. And we also have a particular specialization in eds and meds. So how all of those anchor institutions really support and grow our regional economy. And the region is the 3rd district, which includes all of us in Berks County. Lots of research available, and I point everybody to a very accessible website and accessible research. There's a lot of very geeky kind of econ nerd research, but there's also a lot that's very accessible to the rest of us around early learning, healthcare, student debt, things that are fascinating that really affect us day in and day out.
Yeah, thank you, Julia. That's several very good points. One of which is, everybody's looking to the Fed Reserve to solve whether we're going to go into recession or not, and the tools that you have are so limited. But the information you have and your ability to present that information is incredibly valuable and incredibly important. It's been very useful for us. Rio, I wanted to ask you one last question here. Early on, you talked about Berks County and how it compared to the other counties in the Federal Reserve District. And we were sort of maybe in the middle, maybe in the lower end of the middle. What should we be worried about that? Is that something that should be a concern for us?
So I think the answer to that question depends on who you are. I think there are several representatives from the leisure and hospitality sector who shared their experience, and I think that is basically the I would say what we're seeing in the data, right? So leisure and hospitality sector, we're seeing a slower recovery rate, not because of the lack of demand, but lack of supply, I would say. So again, so that may be a little bit more difficult to resolve because if it's a demand issue, then there are some things that firms can do to mitigate that. If it's a supply problem, then that's a little harder. Another point, particularly for Berks County, is the slowness in the recovery for hospital sector, so employment in healthcare providing sector. And again, same problem, not because of the lack of demand. As a matter of fact, demand is skyrocketing. I think the issue has been supply. I do have some data on, let's say, local ads for ads for people, and number one occupation that has been, it's not like the pandemic created this problem. I think this existed before, but registered nurses has been consistently the number one on the list for quite some time, and I think pandemic has really exacerbated that problem. So both the leisure and hospitality sector as well as healthcare providing sectors are essentially being impacted by supply problem for people.
The healthcare, education, leisure, travel, and manufacturing are, that's the heart and soul of our economy here. So if people have questions, they have your contact. We will send everybody a copy of your presentation. It was incredible. Thank you. And we will send everybody a copy of the video. And I do want to thank everybody for joining us. Our next community forum is in March. It's not on a Thursday. It's going to be on a Tuesday, March 16th. And it will be featuring people from the Brookings Institute who are going to talk about the potential of Pennsylvania in terms of being a Commonwealth of innovation, and the fact that we are slipping behind where we have some great resources and assets. So it should be a very interesting conversation for you who join us for that. Rio, thank you, and thank the Federal Reserve Bank as always. You guys are terrific partners, and this was a great presentation.
Thank you.
And everybody else, we will see you hopefully at a future event.
Thank you,
Thanks,
guys.
everybody. Have a super day.